This Fortnightly Market Outlook webinar. I am Devarsh. I am joined by my two colleagues, Vinay and Nandish. Good morning, Nandish.
Good morning, Devarsh bhai. Good morning, friends. Welcome to this webinar.
All right. Vinay, how are you doing?
Yeah, I'm doing fine, Devarsh bhai. Thank you and welcome you all in this Market Outlook webinar.
Okay. So over the next half an hour, our aim is to share the international developments, the global indices, and share market view based on technical and derivative perspective. So without further ado, let's start. Let me share my screen. Can you confirm, is it visible?
No, Devarsh bhai, still not visible. Now visible.
Can you see the Fortnightly Market Outlook webinar slide?
Yeah,
Yes.
yes, now it is visible.
Okay, thank you. So let's start. So what has happened yesterday after the US market closed, the Moody's rating agency, they have downgraded the US credit rating agency, credit rating. And now, as you can feel, the once the credit rating is downgraded, there is always some nervousness in the bond market. Why they have downgraded? Because there was one bill which was pending in front of their parliament, but they could not clear it. There is some difference of opinion between the Republicans, and because they could not clear it, the Moody's chose to reduce the rating from AAA to AA1. This is the first time Moody's have done it after 1999. They are the third agency. Fitch did it in 2023 August and Standard and Poor did it in 2011. So S&P did it in 2011 and Moody's waited till 2025 to downgrade US sovereign rating. This time when the first in 2011 happened, market crashed 20%, then recovered. In 2023, it crashed 5% and then recovered. And this time I'm not expecting that market will crash so much, 1 or 2% down, but then hopefully it will recover. Why they've chosen to do that? Because US is forecasted the way they are spending money, where they are doing, the fiscal deficit may go up to 9% of GDP by 2035. It is right now 6.4%. So such a huge increase in debt is making them nervous. And gradually, day by day, as their debt is increasing, the payment towards the interest of debt is ballooning, and that is creating nervousness across the market. So this downgrade follows the heightened uncertainty in the US financial market as Trump's decision to impose tariff on key trade partners have over the past few weeks sparked investors' fears about higher pricing pressure and sharp economic slowdown. So it is a big deal. It is one of the important markers, and this will have repercussion across the globe. Why? Because US Treasury needs to refinance $9 trillion of their treasury, out of which almost 2.5 are due for the renewal in within a year. So as we know, the US had negative deficit with China. So China was one of the major buyers, but because they have trade war, the Chinese are not buying. Gold is comparatively a very small market, and all this money which was earlier going towards treasury will find some new buyers, and it will have a huge implication on emerging markets like India. Trump policy may lead to some disruption in debt recycling, and if this debt recycling is disturbed, then we are looking at a major catastrophe in US. If any auction is failed, then there will be pressure on US to change their policy. Or if US Fed is pressured, instead of reducing the amount of money, the quantitative tightening they are doing, they will have to do a volte-face. They will have to start another round of QE in order to support the US debt market. So interesting times are ahead for US market. US markets are right now showing higher growth than expected. Analysts were expecting about 6% growth in S&P 500 companies. They have exhibited more than 12% growth in earnings. Earnings are very good. And that means that the US markets are likely to be well supported till this problem is solved. This problem is going to persist. So over the next 1 year, from these levels, our stance on US market will continue to remain cautious. So global markets, emerging markets, all the money, all the other asset classes, gold and others, will continue to receive good flows at the expense of US markets after a few weeks, once the earning season is over. So we can say that US markets are in their, they are near their all-time highs, but we don't expect large outperformance. MSCI emerging markets, which are in a small range of, or a range bound for last 20 years, there is a possibility that if small amount of money flows back from US into these markets, this trend can reverse and India could be a major beneficiary of this flows. Another important event happened yesterday. US plans to put 5% tax on remittances made by non-US citizens, and this will hit the Indian remittances. If you see, India has been the major beneficiary of remittances. Remittances is the money which is sent from abroad back into India. People who have gone abroad, they are sending money to their families or sending money back into India for other various purposes. It has been growing at a 10% CAGR for last 24 years. India is the largest receiver of remittances. India gets about 27.7% of $27.7 billion of remittances from US. US is the largest source apart from UAE. And this can have a hit, about $1.5 to $2 billion can impacted. Which are the states which receive the maximum remittances? Maharashtra and Kerala are about $20 billion each, and they can get some impact because of this. What are the other key developments over the last fortnight? One is the US-China agreement to reduce tariff. This is a major positive. This triggered a major relief rally across the globe. And also on a somber note, Federal Reserve Chairman Jerome Powell cautioned that the global economy may face a volatile inflation due to frequent supply shocks, and this is because of the Trump's tariff policy, and that is complicated central bank policy. So interest rate reduction are a question now because of the uncertainty. So this is what has happened. One more important tweet which has come is that the US President Trump said that the trade deal with India is coming soon, and India is willing to give a lot of leeway to US to do this trade deal. So over the next fortnight to 1 month, we can expect India's trade deal with the US. India had already done a trade deal with UK, and other many countries and many free trade agreements are on the anvil. Over the next 3 to 6 months, we may see a lot of trade deals of India with other part of the globe. Okay, so all this US trade deal with China led to a sharp rally over the last 1 month. You can see S&P 500 and Nasdaq. Dow Jones are up 7%, S&P is up 12%, Nasdaq is up 17%. Out of this 17%, about 7% or so has come over the last fortnight. Many markets around the world are rebounding because of the less uncertainty, as you can see, from between 7 to 1%. Indian markets are also rebounded over the last fortnight. 2% rise in the Sensex and Nifty, over the last 1 month, about 7% rise. Mid cap has gone up by 9% over the last 1 month, and small caps have gone up by 7%. This is likely to continue. Obviously, in the last fortnight, many of you, all of you must be knowing what has happened in the geopolitical issue, the Operation Sindoor, and all those details we have amply covered. So, for the paucity of time, I'm not going into details, but that has also led to a resounding thumbs up from the markets. Why we are hoping or expecting that the mid cap, small cap will continue to do well? Because right now the Nifty small cap index is trading around 17,560, while all-time high is around 19,716. So there is still huge room for our mid cap and small cap to go back to their all-time highs. The mutual funds are sitting on a large cash. Unless there is any sentimentally negative factor coming in, we expect these indices to go back to all-time high on back of this cash which they have, and they will be willing to deploy. The earning season is more or less as per our expectation. This quarter, good growth has come in. Most of the mid cap and small cap companies have beaten the analyst expectations. We expect that the next year growth is also in line with the it's going to be in line or little higher than the market expectation. Double-digit growth on between 10 to 15% Nifty growth is expected, and that means smaller and mid-cap companies will continue to grow. What are the sectors which are doing well? That is also important. Capital goods, auto, metal, and IT have done over the last fortnight. Over the last 1 month, as you can see, IT has rebounded sharply. Capital goods, auto, and technology has done well. My colleagues will share technical and derivative perspective where long build-up are there, what charts are telling. So that will show us where to position for our next fortnight. The FIs which were selling continuously now has turned buyer, and their net purchases over the last 12 months has reduced from huge negative number to only 7 billion negative number. So FIs have become net buyers now, and that is helping the overall market. So that's what I wanted to share. Now I'll come back in the second half of the webinar to share about what we have done over the last fortnight, what kind of recommendations and what kind of stocks we recommend, how do they fare. But before that, let's hear from our colleagues what is happening in the markets from technical and derivative perspective. Over to you, Vinay.
Okay, Devarsh, let me share my screen. Is my screen visible, Devarsh?
Yeah, visible. You need to put it on the full screen.
Yeah, now it's okay.
Yes, go ahead.
Yeah, so good morning, friends, and welcome to this webinar. So I am going to talk about the technical developments on the Indian benchmark indices. We will also discuss about how the intermarket analysis is placed and how global markets are placed. And based on that, we'll try to conclude the view on the markets for next fortnight. So without much ado, I am starting my presentation. Yeah, so starting with the Nifty. So as we all know, Nifty has been to a clear-cut uptrend for last 1 month. We have seen a nice recovery from the lower level. So on 7th of April, 1 minute, let me. So this was the candle which was formed on 7th April. At that time, the low was 21,743. And from that level, Nifty has risen by more than 15%. So stellar rally has been registered in short span of time after a easing from getting out of the geopolitical tensions. Nifty has already given nice returns, and broader markets have already recovered sharply. So 15% rally. Most of the retail participants and traders have been feeling that they have left out the rally and not being participated. But according to us, still there is a lot of steam left in the market. The reasons I will explain in the detail. So this is a Nifty's chart of the daily chart, more than 15% rise. Now look at the emerging market indices. So this is nothing but the MSCI Emerging Market Index. So if I were to look at the return given by this index from the April low, this index has gone up by more than 19%. where we can see Nifty has just risen by 15%. This emerging market index has given a return of more than 19%. That means emerging market indices have given more return than Nifty as of from the low of the April. This means not only the Indian markets but emerging markets across the world is giving a good return. So global rally is there, and on the back of that, we are also participating in this rally. So we are not the alone which are rising, which is rising. All emerging markets are rising and rising more than us. It's a good sign that global market setup is positive, and it will definitely help Indian market as well in the coming time. Now, coming to the world market index, which is a developed market index like US and Europe. So from the low which was seen in the April, the world market index has given a almost given a performance of 22% positive. So it has even risen more than the emerging market and Indian market as well. So world market setup is quite strong. The recovery has been very strong, and more than almost 22% return we have seen from the April low. So global market setup is quite good, developed, as well as the emerging markets are rising and rising more than Indian markets. Indian markets have just come out from the geopolitical tension, so there is a good room. There are good news also which can support the Indian markets, and they will ultimately catch up the world market as well as the emerging market. And the performance we can expect in the coming days should be positive only as far as short-term trend of the Indian market is concerned. Now, where indices are headed. So basically, the all-time high was seen at 26,277. This was the high registered in September 2024. And from that level, we saw a 18% correction towards 21,743. So entire fall, if you were to take the retracement level, Nifty has already retraced more than 61.8%, which negates the entire downtrend. So whatever downtrend was there in the market, it has been negated as Nifty has already retraced more than 61%. 61% level was placed at 24,500 odd, and that has been taken out decisively. Now the next retracement comes in at 25,200, which happens to be the 76.4%. So this is the immediate resistance from where we can see some sort of profit booking. But the way it is placed, the way it is going, the way it has surpassed the 61.8% retracement, there is a high probability that the 100% retracement we can see from here, that is nothing but the previous all-time high placed around 26,277. So according to this chart, it looks like that there is a very high probability that in the coming months, we can see Nifty headed towards the new all-time high. Not only the price, but if you were to go by the MACD and the RSI on the weekly chart, this is a weekly chart, and clear-cut bullish setup is there on the MACD and RSI. So this shows the sustainability of an uptrend, and this uptrend should remain last for the next coming months. And there is a good chance that Nifty can hit an all-time high in coming months. I'm not giving a view for next week or 15 days, but this is a positional view, and we need to track it accordingly. So yes, the overall setup is quite good, and the setup of the Nifty is very strong in the coming times. Now, yeah, what should be the support? So support is placed around 24,500. The 61.8% retracement resistance previously, which was taken out, now it can interchange its role as a support. So the 24,500 can act as a very strong support in case of the correction or dip, any intraday dip comes in the market. This should be the support level from where we can again see resumption of an uptrend. So once we see some correction on any news, then 24,500 should act as a strong support, and existing long should be held with a stop loss of 24,500. And ultimately, it should be kept on the trailing basis. Once we see markets are keep on rising from this level, then we need to keep the stop loss on trailing basis so that we can capture the entire whole rally from this upward turn. So 24,500 is should be the stop loss in trading long position in the Nifty, and it should be kept on the trailing basis. Time to time, we will come out with a support level and trailing stop loss level. We will definitely share those levels in the coming times. Now, this is another important chart which needs to be tracked. This is nothing but the Nifty Next 50 chart. We call it as a junior Bs. So after top 50 companies, there are 51 to 100 companies, top 51 to 100 companies. This is the index of that Nifty Next 50. So it is placed far from its all-time high, and this is a weekly chart, and this is a downward sloping trend line adjoining the previous highs. So this is a clear-cut breakout. We can see there is a trend line breakout, and this gives a fresh buy signal on the Nifty Next 50. So this is a large cap index, and this needs to be tracked for the larger cap stocks. So this is a very good sign. This indicator oscillators are giving clearly bullish sign. So this index can be captured with the help of exchange traded funds also. There is a ETF available in our MTF category called Junior Bs. It has got a very good liquidity also. So Junior Bs ETFs can be bought if you want to capture this view. If you want to utilize our bullish view, you can also go for the Junior Bs ETF, which is available in the MTF. So this is a clear cut breakout, and Nifty Next 50 is headed higher from this level, and good upside we can see from here. Now, coming to the Bank Nifty, so Bank Nifty has been into a consolidation for last 1 month. And as we can see, this is a flag pattern, a consolidation pattern after a big run from the March lows. Now, if Bank Nifty were to break out from this flag pattern, which the resistance of this flag pattern is placed around 55,600, any level above 55,600 in the spot Bank Nifty will bring back the momentum in the Bank Nifty. As we all know, the Financial Nifty and Bank Nifty already registered an all-time high, and after that they came into the consolidation. Now again, this is coming near to the breakout level. Any level above 55,600 could generate a very good upside on the from here. So 55,600 is a resistance above which we can even see a rally of more than 2,000, 3,000 points also. So very strong setup on the Bank Nifty. And as far as support is concerned, the support is placed around 54,400 to 54,500 zone. This is nothing but the last 5 days low. This is a strong base, and also the unfilled gap is there, which can provide support at lower level. So we are asking traders to remain long in the Bank Nifty with the stop loss of 54,400 to 500 zone. And on the upside, if Bank Nifty were to cross 55,600, then we can even see a rally of more than 2,000 points from that level. So very strong setup is there, and on the verge of breakout Bank Nifty. And obviously, the private sector banks are looking very strong and having higher weightage in the Bank Nifty. They can help from here to the Bank Nifty to extend the gains. Now coming to the some sectoral indices, so this is nothing but the Nifty Consumption Index. So as Devarsh bhai shared that many sectoral indices gave a fantastic return, but FMCG and Consumption Index are the indices which did not give that much return as compared to the IT, as compared to the metals and capital goods. So this has, as we all know that we are into a uptrend and sector rotation is going on. The sectors which did not participate in this rally can come now and see the catch-up rally. So this is a Nifty Consumption Index, and this is a daily chart of that. And as we can see, multiple tops were placed around 11,000, and we can see that in this week we saw Nifty Consumption Index crossing that 11,000 mark. So it is a clear-cut breakout. Many FMCG stocks and consumption stocks are the part of this index. And this view can be captured with the ETF, which is available in the MTF category. The name of the ETF is Consume I ETF. It is an ICICI Prudential Consumption Index ETF, which is available in the MTF site. So this view you can capture with the help of ETF, which is available under HSL MTF list. This is another important index we need to see. This is nothing but the Nifty IT index. So this was the long hammer candlestick pattern on the monthly chart. So let me tell you, this is a monthly chart. This is not a daily, weekly. I'm sharing the positional view here. So was a monthly chart, and this was the candle which was formed on in the month of April. So long legged hammer candlestick pattern was registered, and after that, in this month, in the month of May, we have already seen a rise of more than 6% in the Nifty IT index. This confirms the positional uptrend. And now the trend line, which you can see over here, downward sloping trend line, this gives the target of around 39,000 in next couple of months. And right now the level is around 38,000. So 1,000 to 1,500 points rally further we can expect positionally from the IT index. So yes, there has been a rally in the IT index, but every dip should be considered as a buying opportunity, because this is a very important development on the IT index monthly chart, and this is the positional setup. So obviously we can have a bullish view for the IT index for the next couple of months, and we can expect a healthy upside in the large cap IT stocks. Last but not the least, I'm not going to discuss about any these specifically for micro cap, small cap, or mid cap. Let us discuss about the breadth of the NSE 500. So NSE 500 is nothing but the broader market benchmark index. It will help us to understand how broader markets are placed and how where they are headed from here. So this is nothing but the percentage of stocks which are placed above the 200 DMA in NSE 500 universe. So the current number of the members about 200 DMA in NSE 500 has reached to 44%. So in the month of February 2025, we all know that there was a panic selling in the mid caps, and at that time this number reached to as low as 10%. So 10% stocks above 200 DMA was very extreme lower end. And in the bearish trend previously in the history, we saw that in the year 2018, then 2016, then 2011, and going back to 2008. This was the scenario when this kind of setup was seen, and the same oversold scenario was emerged. We also shared this view and the observation in our webinars and as well as in our weekly technicals, that this number reached to the oversold, and very good chances was there at that time that the broader market should bounce back. Now, what we can see from here, so 44% from the 10%, nice recovery has been already registered in the market breadth. Now, where we are headed. So, if you were to look at the historical data, whenever this number rose from the oversold territory, it at least went up to 65, 70%. So, right now, the 44% is still not overbought from the average number which we consider around 65 to 70. So at least we can expect the percentage of members about 200 DMA to reach around 65 to 70% number. The overbought number is around 95, 96, which we saw in the month of 2009 and again in 2019. So this we are, at least we can take an average number of the rise, and this number comes around 65 to 70%. So right now we are placed around 44. So still there is a good steam left in the upside, and we can expect broader markets to further extend the bullishness from here. So let me conclude what we have discussed till now in this presentation. So Indian benchmark indices are in a clear-cut uptrend. Immediate resistance for the Nifty seen at 25,207. Nifty has got good potential to hit fresh all-time high once we see any level sustainable above 25,200. Positionally, in next couple of months, we can expect Nifty to hit an all-time high. There is a good probability. Support for the Nifty is placed near 24,500. So this should be the stop loss for the existing long position. Bank Nifty is on the verge of breaking out from the bullish flag pattern on the daily chart. So 55,600 is the level above which Bank Nifty is likely to extend further with a momentum. Support for the Bank Nifty is near 54,500. This should be stop loss in the Bank Nifty longs. Broader markets have been performing very good, which further confirms the healthy bull markets. Percentage of stocks about 200 DMA in NSE 500 have reached 44 from 10%, which is a good sign. This number is still far from the average number reading in the bull market. So as I just discussed, that there is a still good steam left on the upside in the broader markets. Global market indices like MSCI World and emerging markets are in a clear-cut uptrend. Sectoral indices like consumption and IT are looking very strong on the positional charts. Nifty Next 50 index has given a fresh breakout on the weekly chart, which indicates healthy upside in the next 50 stocks. This view can be utilized by going long in the Junior Bs. Junior Bs is a code of ETF available in the MTF category of HSL. So this view can be captured with this MTF. Considering the technical evidences discussed above, we believe that Nifty is into a strong uptrend. Traders should continue to hold on to the long position. Dips should be bought into. Any close below 24,500 in Nifty could change the bullish stance. On the upside, immediate resistance is seen at 25,207. Once we see a sustainable close above that, then we can even expect higher levels. Derivative side, there are some hurdles at 25,500, 600 zone, which my colleague Nandish will share. So there are intermediate resistances around 25,500 to 600, about 25,207. So for Fortnightly, we can consider 25,200 and 25,500 as a resistance. But ultimately, it looks like that there is a high probability that Nifty will also hit an all-time high in coming times. So this is what I wanted to share from the technical side. Now my colleague Nandish will share the view on the market on Nifty, Bank Nifty, and sectoral indices from the derivative perspective. So over to you, Nandish.
Is my screen visible?
Yeah, yes, you have to go to the presentation mode. Nandish, go
Is it
into the
okay now?
presentation. Yeah, it's okay.
Okay. Yeah. So again, good morning, friends. I am going to share how the market is looking from the derivative side. So let's straight away jump to the presentation. Nifty registered an impressive weekly gain of 4.18%, and this is the highest weekly close for the Nifty since week ending October 4, 2024. So Nifty has almost reached to a 7-month high. And during the last week, we have seen 7% rise in the Nifty futures open interest with sharp rise in Nifty, which suggests build-up of long positions in the Nifty futures. Now coming to Bank Nifty also gained 3% during the week, and on weekly basis, Bank Nifty closed at all-time high. And in the Bank Nifty also, we have seen long build-up where 2% rise in open interest we have witnessed during the last week, with Bank Nifty rising by 3.3%. So both Nifty and Bank Nifty, we have witnessed long build-up during the last week. Coming to option data, Nifty open interest put call ratio rose to 0.97 levels uh, yesterday as compared to 0.94 levels last Friday. So week on week, we have seen slight increase in the put call ratio. And among the options, we have seen put writing at 25,000 levels, 24,500 and 24,700 levels. So at multiple levels, we have seen aggressive put writings, which suggests that market players are expecting limited downside. They are not expecting market to fall much. On the higher side, 25,000 to 25,200 level is likely to act as an immediate resistance where we have seen some call writing. So we are close near 25,000 level only. So this range of 25,000 25,000 to 25,200 is likely to act as an immediate resistance. But once we manage to surpass 25,200 levels, we are headed to 25,500, 25,600. That's what the derivative data is suggesting. So you can see from this option distribution chart, this red candle is of put. So we have seen put writing at 25,000 level, 24,700 levels, and 24,500 levels. While on the call, we have seen call writing at 25,000 level, 25,500 level, 25,100, 200 level. So broadly, market is looking strong. On the lower side, 24,700 to 25,000 is a immediate support band, where on dips you can create your longs, and 25,500 is the important support area where we have seen aggressive put writing. Coming to FI's data, though Nifty moved up by 4%, we have witnessed profit booking by the FIs in the index future segment. They have net sold worth rupees 3,000 crore during the last week, with their open interest going down by 9,500 contracts, which suggests profit booking by them. If you were to see the breakup, FIs have created minor shorts in the Nifty futures while they have reduced longs in the Bank Nifty futures. And that's why the long to short ratio fell to 0.74 levels from 0.91 levels last week. So here, though Nifty is at 7-month high, FI's long to short ratio is still below 1, which suggests that they are net shorts. And actually, our experience says that this augurs well, because Nifty is at 25,000 levels, still the FIs are net short. So if market were to rise from here, FIs could cover their shorts, which could give support to the market. So actually, FI's long to short ratio below 1 is good sign. Their long to short ratio is not reached to an overbought level, and therefore this data also indicates that we are at higher levels. We might see short covering by the FIs in the days to come, which augurs well for the market. So here you can see from this chart, FI's long to short ratio on 9th April it was 0.28. It moved up to 1.09 on 8th May, but during the last week it again came down to 0.74 levels. While this red line shows the Nifty has been rising continuously from 24,000 odd levels. It has reached to 25,000 levels during last few days. But FIs have reduced their longs, which suggests that in days to come you might see short covering by them, which could give support to the market. Now, so coming to outlook, long build up in the Nifty futures, rise in put call ratio, uh, and on the back of put writing at 25,500, 24,500 to 25,000 levels. However, though we have seen rise in put call ratio, it is still below 1. Normally, put call ratio, we can say that it has reached to an overbought level once it reaches to 1.3, 1.4. But right now, we are still below 1. So that this ratio also suggests that there is more upside left. Put call ratio has not reached to an overbought level. FIs, they are buying aggressively in cash market, although they have booked profit in the derivative. In cash, they are buying aggressively. As I mentioned earlier, their long to short ratio is still below 1, which could give support to the market. So all in all the derivative data suggests that this we are in uptrend, and this uptrend is likely to continue. 25,000 to 25,200 is an immediate resistance. Once we cross that, we are headed higher. We may see a level of 25,500 to 25,600 in the coming days. So overall, our advice is to remain long, buy on dips, and keep a stop loss of 24,500 for your longs. Coming to Bank Nifty, we have witnessed long build-up in the Bank Nifty futures also. Even in Bank Nifty also, though Bank Nifty is at all-time high, near all-time high, their put call ratio is still at 0.9. So which suggests that it has also not reached to an overbought level, and uh, and there is more upside left for the Bank Nifty also. FI is buying aggressively in cash market. Their net long to short ratio is below 1. All this is beneficial for overall market and Bank Nifty. Technically, as Vinay mentioned, we are near all-time high. On weekly chart, Bank Nifty has closed at all-time high. So our view for the Bank Nifty is also that one should remain bullish. 54,500 should be the stop loss for longs in Bank Nifty, where we have seen aggressive put writing. So that should act as a support. Unless we close below 54,500, we should be buy on dips for the Bank Nifty. 55,500, 55,600 is an immediate resistance level. We have closed near that only. So if we manage to close above 55,600, I think shorts will come to cover their shorts, and we might see a sharp upside. On the higher side, above 55,600, we believe that we are headed to 56,500 to 57,000 levels. So above 55,600, Bank Nifty can give a big up move. As of now, also it is in strong uptrend. Coming to sector, so after a long time, we have witnessed that none of the sector witnessed short build-up. So majority of the sector witnessed long build-up, while few sectors like auto, banking, and metals, they have witnessed short covering. So apart from these three sectors, all the sectors have witnessed long build-up, and amongst them, new age stocks, power, reality, technology, telecom, all of them have witnessed aggressive long buying, aggressive long build-up. So this sectoral chart also suggests that downside is limited and we are headed higher. Many stocks, even in the face of consolidation, many stocks, many sectors can do well, as we have witnessed long build-up plus short covering in all of them. So that is all I want to share. Over to you, Devarsh.
Okay, thank you, Nandish. Is the screen visible?
Yes,
You can see the prime research expiry slide, right?
yes.
Okay, great. So we have shared the view. Now, how do you execute this view? How do you implement this view? So we give recommendations on majorly three categories. One is in the cash market, that is cash trading calls and MTF calls. Another section is the derivative. And third is the delivery based long term investment ideas. So every fortnight, I intend to put focus on various products within these categories. So technical, cash, and MTF we will cover next fortnight. Within the derivative, let's discuss. Within the derivatives, we share recommendations on stock futures, stock options, index futures, index options, expiry calls, that is expiry day, 0 day calls, and also index strategies. So within the derivatives, out of 6-7 different categories of recommendations we give, let's put focus on expiry calls. So in month of May till now, we have shared 12 expiry calls. 11 have been positive and one has been negative. So those traders or investors who are interested in trading expiries on the Thursday for Nifty. We have calls on Monday, Tuesday for bank Sensex related calls. Whenever there is a weekly expiry, 2 days in the week, we have a lot of expiry calls. So focus should be there. Those who want to trade, these are high risk, high reward kind of strategies where within the span of few hours, either you increase your the amount which you have put into the trade, it goes up 50%, 100%, or it goes down by 50, 100%. So small percentage of capital, 0.5% of your trading capital, 0.2%, 1% of the trading capital, depending upon the risk appetite you have, you can put into the expiry calls and make a benefit out of this. Apart from that, those who are starting, those who are new to the derivatives, you can use the index strategies. Two strategies are already given. Both have been turned out to be positive. One is still open. So focus on index strategies and expiry calls. The another product, so technical side, derivative side, two section. Third section, which is the long-term investment idea. That is the pick of the week. Pick of the week is basically ideal mix of conservative and aggressive ideas for long-term investment between 6 to 9 months. Our hope is to cover one investment idea every Monday, where if market goes down, it is likely to fall less, and if market goes up, it is likely to rise more than the market. We are hoping that this will give you better return than the indices, better return than the small cap and mid cap index. One investment idea every Monday. The way to trade is that you put 5% of your capital into each idea. Try to make a portfolio of 20 stocks. As in when a profit is booked, you move that capital, churn that capital into a newer idea. That way you can generate better return. Same capital can be used again and again to generate higher return. So these are the 20 stocks which we have recommended from the 1st of January till now, every Monday. On an average, they have been able to generate 12% return. And if you generate this capital again and again, obviously you could have generated about 21% return, because many of these stocks, these 7 stocks have already generated good returns. So that's what we wanted to share. Now, if you have any questions, we can easily share those. We can try to answer those questions. Nandish, you can stop sharing your screen. So if you have any questions, you can put it into question and answer or the chat window, and we'll try to answer them. So short-term picks, Ritika is asking. So short-term MTF and positional MTF are our calls which we issue. We will cover their track record over the next fortnight in the next webinar. But we do have cash short-term calls, the MTF short-term MTF, and also the positional MTF calls. We do. View on the defense stocks have been positive. We have issued many defense stocks as a part of our MTF. We have also shared as a part of our positional pick of the week. We cannot answer stock specific questions here in a public forum. If you have any question related to any indices or sector, we can share that with you. Recommendations have been really good. I just started last week. So congratulations, you started in a week where a lot of traction was there. So you have made good money. This is from Ritika. The idea is that there will be 60 to 70% kind of a success ratio in depending upon the different products. Some products will be successful in some weeks, some months, or other products will be successful in other weeks. The idea is to follow them religiously over the long term, and that's where you will be able to generate more return. We do give BTST kind of calls in derivatives, index futures, around 2:30 to 3. We share those ideas where we book profit or loss on the next day morning, so you can use that. Trump tariff saga is over. Mohsin Raja is asking, yes, most of the problems, the worst of the uncertainty is over. Now he is retracing his aggressive stance. He has done a deal with the UK. He has already started talking with China. So there will be ups and downs. Right now we are at the positive leg of the tariff tantrums. There could be some delay. There could be some problems, but overall we are behind the worst of tariff problems. View on the railway sector is positive. A lot of money is being invested by the government in the railway stock sector. Logistics is also one of the emerging areas. The Delhi Mumbai freight corridor, East West freight corridor are coming to conclusion after 5 to 10 years of huge investments. That will start generating a lot of benefit for the logistic companies over the next 6 to 12 months. Yogeshwar is telling very good and informative session. Thank you, HDFC Securities team, for valuable insights. Thank you, Yogeshwar. PSU banks, so our view in the PSU banks have been positive, but now after these quarterly results, we need to be a little cautious. The private sector banks are looking more positive. We do have commodities also as one of the section where we provide trading recommendations on commodities and also base metals. Our view had been quite bullish on gold after the tariff, this war-related uncertainty. When it did not perform, that was an indication that the supply is more than the demand. That's why gold has been stagnating. But if there is any problem, see, the problem right now is not in the emerging market, not in the European market. I am worried about longer term problem in the US market because they have a debt. So if there is any accident in the US debt market, gold will zoom. And we have to keep that as a possibility over the next 12 months. So that's why we recommend about 5% kind of allocation in your portfolio towards gold. What may happen is that if they are not able to roll over their debt, if there is any failed auction over the next 12 months, US markets may fall. In 2008, let me jog your memory, Lehman Brothers collapsed. US market fell, European market fell. They fell about 15 to 20%. Indian market went down 60%. So that suggests that if US market were to go down, if they catch the cold, they will sneeze, we will catch the cold. So we are a smaller market. We have to be worried about what is happening into US market, and US market is going to pass through little bit of uncertainty over the next 12 months. So that should temper our expectation. But our fundamentals are strong. Our markets deserve a lot of capital from those markets. US market is about 20% of GDP, but their market cap is about 55%. So that means incrementally, a lot of capital which has gone into US market should come back into the Indian market and other markets of the world, European market, commodities. And I'm expecting that for the rest of 25, those markets, European markets, emerging markets, commodities, base metals, should outperform the US markets. There are about 13 MTF stocks are open. So Sagar is asking, yes, you can look at those short-term MTF for the trading in the MTF segment. All right, I think I have answered most of the questions. Any closing comments from you guys? Vinay?
Yeah, so as we discussed, after 15% of rally, still we believe that the trend should continue, and the way things are panning out, the way global markets are performing, the way broader markets are performing, it looks like that we have come to the momentum zone where we can expect higher returns in short span of time. So try to utilize this view with the help of ETF, with the help of MTF calls as well as the derivative calls that will help us in generating alpha.
Okay, Nandish, you are on mute.
Yeah, so make the hay while the sun shines. Actually, mid caps, small caps are doing well. Large caps are also doing well. So follow our calls and do profit.
Yes, so as Nandish pointed out, we are witnessing good markets, good recovery from the lows. At the end of the March month, beginning of the March month, we came out with the strategy where we said that the worst is over. We have been able to capture this upside. A lot of people have been following calls. Those who are following calls have been able to generate good profits, good appreciation in their portfolios. We recommend that you continue to do that. Good times are ahead, and let's try to capitalize on them. Thank you very much. Thank you, everyone. Thank you, Nandish. Thank you, Vinay, for joining. And we can close this webinar.
Goodbye.
Thank you.
Bye.